Ladies and gentlemen, good day and welcome to the Computer Age Management Services Limited Q1 FY23 results conference call hosted by Orient Capital. Today we have with us on the call Mr. Anuj Kumar, Managing Director, Mr. Ram Charan, CFO, Mr. Anish Savlani, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anuj Kumar, Managing Director, for his opening remarks. Thank you, and over to you, sir.
Hi, thank you, Seema, and good morning, everyone. Welcome to this earnings call of CAMS. I will quickly give you a broad overview of how the quarter panned out, and then we will take you through a more structured presentation. Some of you may have downloaded it already. But just in terms of the background and how the overall quarter went, as you know, it's been a slightly tough quarter. And why do I say that? That's because stock market indices saw some sustained headwinds, and therefore valuation of equity assets did see an impact. Also, because of certain circumstances in the background, new fund offerings, as you're aware, did not happen almost throughout the quarter. And this did impact build out of equity assets as well as slowed some of the activity we see in the KRA company. Despite these two things in the backdrop, there are consistent positives which played out through the quarter at the foundational level. And I will speak about the key ones, and they do give an impression that foundationally it's a strong market and the right things were happening. The first, of course, is that in terms of equity inflows, that's perhaps the most important metric here. Gross and net equity inflows for us remained buoyant. Our net equity inflows showed up at 37,000 crores, so which is a remarkable number given the quarter. Given this, equity assets actually grew despite the headwinds in the stock markets. Equity AUM actually grew and grew by 2.6%. SIP inflows remained consistent in the quarter, remained over 20,000 crore. And you know that number has perhaps been expanding for the last 5 or 6 trailing quarters. This was the highest number that we have recorded. So we grew over all the previous trailing quarters. SIP registrations, when seen in the context of the previous quarter, in context of 4Q FY23, was slightly muted. There were 36.5 lakh compared to 43 lakh in 4Q. But if you see a year-on-year trajectory, we grew handsomely. This number was 28 lakh in 1Q last year and grew to 36.5 lakh during the quarter. So year-on-year, a strong increase. Overall AUM, despite the growth in equity AUM, contracted by 1.6%, largely led by what was happening to bond prices, interest rates, and therefore debt and liquid assets. Amongst the other businesses, our AIF business grew 30% year-on-year on the back of sustained signings, and we expect it is poised to have a similar run over the next 12 months too. So grew 30% year-on-year in revenue. We continue to invest in new businesses, especially in NPS, PRA, and account aggregator. And we do continue to focus our energies and push the agenda forward on MF Central, as you're aware. Our payments business also grew revenue year to year, 20%, riding on the back of new customer acquisition. So that is the overall commentary on how the key metrics related to our businesses panned out. I will just get into a little more detail. Like I said, talking about the core business, about the mutual funds business. So a 2.6% increase in equity AUM despite the headwinds. Overall assets, like I said, saw a marginal decline of 1.6%. The other important thing is that our share in key metrics, and I will talk of net sales and SIP registrations, improved quarter on quarter, and we retained market leadership with a 69% share. In the alternative services market, we continued the growth trajectory. Like I said, recording 30% year-on-year growth in revenues. Specifically, CAMS WealthServe, which is our digital onboarding platform, has been well received and that momentum continued. We now have 40 plus clients who signed up on this platform. Nobody was expecting the digital penetration of the AIF and PMS market to be so quick. All this has happened within 1 year, so we're expecting this trajectory to continue. On NPS CRA, we, as you're aware, had launched the first CRA platform on the cloud in March 22. eNPS is now live. EOP sales and corporate business are in pilot phase. I think the important thing is that within a short span of time, we've achieved over 10% share in eNPS sales. Like, this is direct to consumer purchase, mostly by people by paying monies from the bank accounts, no employer contribution kind of architecture is there. So we got to number 2 position in eNPS at over 10% market share. Similarly, in account aggregator, we recorded 10 new wins, took our overall tally to almost 20 sign-ups. We now have 12,000 downloads of the mobile app, the most downloaded account aggregator app now. MS Central did well. It kind of solidifies our role in the MF ecosystem. And we are seeing significant interest from fintechs in particular for the CAS APIs and for various other transaction kind of APIs. We'll talk a little about that further. And amongst our other digital assets, MyCAMS crossed 5.25 million user base and continues to retain its position as the largest MF-only app in the country. In insurance, the Policy Genie deep contact tracing solution, we'd spoken a little about this in the last 2 quarters. We assisted insurance companies in closing out almost 31 crore of unclaimed benefits. In 1Q, as you're all aware, this is an important metric for insurance companies. And then overall, I think from a digital solutions perspective, we continue to improve our relationship with insurance companies and improve our delivery capability to the insurance policyholders across the board. As you're aware, we continue to build out the nature, the character of the company to be a full stack and intelligent platform for capital markets. So if you see what do we have there today across eKYC, e-signing, digital onboarding, and we have digital onboarding platforms almost across the board, anti-money laundering checks, validation services. All of these together with the core MF and the core AIF platform create a 360-degree digital stack for the capital market ecosystem. And then outside of those, that we've been assisting banks, NBFCs, and our PMCs in ensuring there is a simplified, accelerated architecture for loan against mutual funds. Our reconciliation product continues to find acceptance both with mutual funds and outside, especially with insurance companies. And like I said, MS Central has now continued to improve its relevance among the consumers certainly, but from a business enablement perspective, we see the fintech stepping forward and showing sustained interest. Overall, our stack of APIs in terms of how we service customers, intermediaries, and AMCs, that continues to grow. From a CAMS Pay perspective, the UPI has been a very smart addition. And like you've read, we've been the first in the industry offering UPI autopay as a solution to the marketplace. Next. I will talk a little about our share in overall AUM, net sales, and SIP registrations. I spoke about this, but just to get into a little more detail. Year on year, we saw a strong 35% increase in equity AUM, grew from about 8.38 lakh crore to 11.32. Our share in industry's equity assets, and that's, I think, a strong redeeming factor, that has increased by 3% year on year, from 62.7% in this quarter last year to 65.7% in 1Q FY23. So if we see, I mean, despite the fact that it was a slightly tough quarter, when you see the fact that equity inflows remain sustained and very strong, and these are net inflows, not gross. SIP inflows were at the highest ever. SIP registrations improved handsomely over last year. And the share in industry's equity assets has grown almost 3%. When you club all of these four facts together, it points to a strong foundational trend. Like I said, our new SIP registrations grew from 28 lakh last year, 1Q, to 37 lakh this year. Our share in new SIP registrations again moved up significantly, 61% now to 55% last year. These are numbers that you've been seeing over the quarter, so you can see the contrast. And then I think from an SIP inflow perspective, if you see the various numbers, October to December 22, which was 3Q last year, just under 19,000 crore. Jan to March 4Q, over 20,000 crore. And then 1Q at 2953, just under 21,000. So that machine continues to grow in the last two quarters, almost clocking 1,000 crore more than the previous quarter. The underpinning to that and a leading metric to that is the SIP registration count. And we believe that this juggernaut will continue to remain intact in terms of momentum. And like I said, CAMP service funds continue to clock over 10 lakh new SIP registrations, all this while for the last many months. In terms of client base, therefore, we continue to service each of the top 5 AMCs, as you're aware, 10 of the top 15 AMCs. But just seeing basis equity assets, which is a carve-out of the market, but an important carve-out, 4 out of the top 5 AMCs based on equity assets are with us. So that kind of shows you the strength of the franchise. A little bit about MS Central. Like I said, we are seeing sustained user interest, which is a great metric to have on our side. This is a property, of course, that the two RTAs are built together. So we see about 1,000 new registrations per day. Of course, this number will move up as we do a formal go-to-market. Right now, there is no high decibel promotion happening, but despite that, we get about 1,000 registrations per day, per day. Mobile app downloads at about 75,000. Executing between 1,000 to 1,500 requests of all kinds every day, touching almost 10,000 login sessions. So it's a differentiated product built as a thin veneer on top of the RTA systems. And like I said, for the combined account statement, which is a popular way to keep investors informed of their holdings and how the portfolios are moving, we're seeing a lot of interest from the fintechs and from other market participants, including advisors and brokers for these APIs, as well as for the transaction APIs. I've spoken a little about the alternatives business. As you've seen, the number of AIFs now registering every quarter is reaching a crescendo, and we are seeing accelerated signing performance now almost for 4 quarters in running, but significantly in the last 2. Riding on all of this, we saw a growth trajectory, revenue clocking almost 30% year-on-year growth. And like I said, we could see, although I don't want to make any forward-looking statements here, similar growth numbers in the next 12 months. New business addition with 50 new wins in the AIF and PMS segment. And of course, growth of business in the base drove all of this. On CAMP's WealthServ, like I said, the adoption has been rapid. Over 40 funds have signed up for our AIF and PMS digital onboarding. Significant new features like onboarding of NRIs, etc., have now been added. And then, like we've said, we want to take this count to make it touch at least 100 within the financial year. On Fintuple, which is a transaction we had announced in April of this year, about 4 months back, Fintuple continues to build momentum with multiple new signups and are now beginning to offer e-sign and e-KYC to their customers. And in the GIFT City, now we are signed up in business now with 5 clients. On account aggregator, I think all of you are aware that public sector banks were all asked to participate in this market by end of July. So technically, all of them are now part of the architecture, coming in to integrate with us. We did our first consumer and industry event for the capital market about 2 weeks back in Mumbai and saw strong participation. And like I said, we continue to sign up banks, housing finance companies, brokerages, etc., for participating with us, both on the AA and TSP platforms. On NPS, like we said, ENPS, which is the segment that we've been live and we've been actively soliciting business and building business, mostly through digital marketing, of almost the 75,000, 76,000 plus ENPS registrations in the quarter. We got just short of 8,000, so that translates into a 10% share and number 2 position. Our government and EPY, which is Atal Pension Yojana, those segments are under design and development. And then we're engaging with the ecosystem entities. PUP and corporates is really the next segment which will go live in the short run. And we're actively preparing to make things happen there. Our CAMPS NPS website logged over 2 lakh visitors. You can see the number there, 2,20,000 during the quarter. From a market share perspective, overall 69% market share, so a stable number. Like I said, net flows into equity assets remain positive. Inflows through SIPs increased 4% quarter on quarter, but the significant metric is improved over 40% year on year. I think that's a significant metric. AUM serviced by CAMS at over 26 lakh crore was 26.2 trillion. Overall assets went up 13.8% year on year, contracted 1.6% quarter on quarter. The very interesting compelling story on equity AUM at 11.3 trillion or 11.3 lakh crore. Assets grew 35% year on year, so significantly ahead of industry, and 2.6% quarter on quarter, again significantly ahead of industry. On transaction volumes, again, on a year-on-year basis, you will see between 25 to 40% improvement just across the board. Overall transaction volumes were 115 million last quarter, so contracted a little quarter on quarter. Year-on-year transactions went 27% up. SIP book, which is the underpinning of all the collections and net flows that you see, grew 37% year-on-year, about 5% over the last quarter. SIP processed, riding on the same metric of registrations, went up 3% quarterly, 39% year-on-year. Live investor folios are now over 5 crores, so 5.3 crores, 53.3 million. Again, 28% up year-on-year, and unique investor serviced is just short of 2.4 crore, 23.6 million, grew 40% year-on-year. So, like I said, if you look at all the foundational metrics, investor participation, SIP book, SIP registrations, net flows into equity, both gross and net, equity market share, and equity AUM, all of those are positive numbers. Despite the headwinds, will not take away the fact that it was a slightly tough quarter overall, and we're expecting at some time for growth to come back to the industry. But despite all that, I think the underpinnings. I will now hand over to Ramcharan, our CFO, to take us through the financials.
Thank you, Anuj. So I will just spend the next 5 minutes giving a flavor of the numbers, the profits, the revenue numbers, and the AUM numbers. As you heard Anuj say, during the quarter, the AUM for Q1 had grown sequentially, had grown year on year around 13.8%. And there was a small growth in the equity funds at 35%. On a quarter-on-quarter basis, there was a small degrowth of 1.6%, but the equity still grew at around 2.6%. So the impact of this is that from a mix perspective, we are having a favorable impact. As you know, equity is the higher yielding asset of the entire mix. and hence you would see from a yield perspective there is some benefit that we are getting from this. From a revenue, for the quarter, we actually had a revenue of 236 crores, which was up 17.5% year on year. The comparable revenue was 201 crores in the last year first quarter, and sequentially it was down 2.8%. If you actually break it down into asset-based and non-asset-based revenue, the asset-based revenue actually grew 16%, 15.9%. If you just compare that with the AUM growth year on year, which was 14%, we generally see the trend where we see that the asset revenue growth is always lags the AUM growth. But because of the favorable impact of the mix, which is that equity has grown around 35% year on year, we are seeing that the asset-based revenue is kind of outpacing the growth in AUM for this quarter, which is consistent with the commentary that we have been giving earlier in terms of the impact of the mix. On a sequential basis, though, there was a small degrowth in the asset-based revenue. Again, if you see the degrowth from overall in AUM perspective was 1.6%, but the asset-based revenue actually went down only by 0.3%. Again, the favorable impact of mix is playing out here. The comparable number for last year, the same quarter was 155 crores versus 181 crores for the current quarter from asset-based revenue perspective. The non-asset-based revenue was up 30% year on year, mainly on the back of the transaction revenue. If you remember, the same quarter last year there was this impact of COVID that was playing out in the markets and in terms of front office transactions. So on the back of recovery of transaction-based revenue, the non-asset-based revenue has come up by around 29% year on year. On a sequential basis, due to drop in transactions and also because of hold in NFOs, which was a regulatory requirement, the number degrew or went down by 9.7% quarter on quarter. The non-asset-based revenue for the quarter is at 33 crores as compared to 25.51 crores for the last year same quarter and 36.4 crores for the sequential quarter. On the non-MF revenue, for the quarter we ended the quarter with a 22.81 crores non-MF revenue. This was compared to 19.7 crores the same quarter last year. Hence, there was a year-on-year growth of around 15.3%. This was on the back of what Anuj was mentioning, a smart growth in the AAF business. We are seeing sustained momentum in the AAF business. And there was growth all around in the repository business, in the payments services, and other businesses. There was an increase compared to year on year. On a sequential basis, though, the non-MF revenue, there was a decrease. From AAF continued to be the bright spot in this, although even on a sequential basis, the revenue grew for AAF. But from other businesses, there was some impact. The last quarter of the year is generally the busiest quarter from insurance and repository perspective, so there will be naturally some degrowth in the April. But because of no NFOs, there was some impact on KRA revenue. So overall, the revenue actually quarter-on-quarter basis came down 10.7%. The asset mix being favorable, there was a positive impact on the yields. I think the research reports have already come out, but year-on-year and as well as quarter-on-quarter, we are seeing the yields remain stable to actually go up marginally, which is again consistent with the commentary that we have given in terms of mix impact and the growth impact. Coming to the profitability numbers, if you see the operating EBITDA, on a non-Ind AS basis was 91.5 crores, which is up 5.1% year on year and down 13% quarter on quarter. From an Ind AS perspective, although this margin was around 39% from a non-Ind AS perspective, from an Ind AS perspective, capitalization of leases, the margin is 41.5%, which is compared to 46% both on the sequential basis as well as the last year. So the reduction in the margin is mainly on account of the investments that we are making. There are 2-3 aspects that contribute to this. One is on the spend that we do on the technology. Because of the AUM growing or not growing on a quarterly basis, our investments in technology resources and in technology in platforms is not going to slow down for one quarter. So we continue to invest in technology. Just to give you a perspective, on the incremental spend that we have done on salaries and other software expenses, more than 35% will be the amount that we have spent only on technology resources, only on platform building out. So this is something that we are continuing. Part of it is a function of the market where we will have to retain people and we are getting high cost resources from a technology perspective. to ensure that our cutting-edge technology remains same. And also from a platform build-out perspective, where there will be some cost that we incur upfront, and Anuj spoke about the various platforms that we are building out in the earlier slides, where there is this MF Central, there is this AA DSP, which actually will have a good revenue potential going forward, but this is the upfront investments that we continue to make by getting high-cost technology resources. So this is contributing to a large part of the increase in salary cost. There is also a non-cash expense of ESOP, which I've indicated also in the presentation. On a year-on-year basis, the ESOP cost is almost like a 7 crore increase, of the 20 crore increase in salary that you see. Almost 7 crore is because of the ESOP, and the remaining things, most of it is because of the technology and other increments that we have to give and the investments that we do in platforms. So that's the explanation for why your EBITDA margin growth and your sales growth, there was a lag between the two. This is something that we continue to invest in, and we're not going to take any short-term decisions to discontinue any investments in resources or technology because of one quarter where we see the assets not growing. That's consistent with our earlier commentary, where we said that in the event of the assets not growing too much, we expect our EBITDA to be just below 40%. And in the event of the assets growing, we are going to be much more than 40. I think that commentary, which we have been consistent over the last few years, has played out in the current quarter, where on an Ind AS perspective, we see a 41.5% EBITDA, but a non-Ind AS perspective, probably a 39% EBITDA. From a PBT perspective and from a PAT perspective, this kind of mirroring the growth in profits and EBITDA. So we are up 2.5% year on year from both PBT and PAT perspective, and down around 12% quarter on quarter. We ended the quarter with a PAT of around 64.78 crores, as opposed to 63.24 crores in the same quarter last year, and 73.8 crores in the Q4 of FY22. Our return on net worth continues to be impressive at around 39%, and we ended the quarter with a healthy cash and cash equivalent around 437 crores. We have declared, the board has declared an interim dividend of 6.75 rupees per share, which you would have read in the press release that we have done. So overall, the revenue tracks the increase or decrease in the AUM. The non-MF revenue had a small dip because of some factors which we have explained. But the investments in technology resources, in platform building out, and in the non-cash charge, as well as the increment that is a function of the market to retain these resources, is kind of having a little drag on the profitability, and that's the overall commentary on the profit. So with this, I'll kind of hand over to the moderator for any questions that the participants may have.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. We take the first question from the line of Anand from White Oak. Please go ahead, sir.
Thank you for the opportunity. In terms of the investments that we are making, do you see the entire impact has come in the current quarter, or we can see incrementally more impact as well in the coming quarters? So, for example, the salary increase 20 crore. Is there more absolute salary increases that are going to come due to additional hiring that might have happened in maybe last month of the quarter or something like that?
So, Anand, to answer your question, it's not expected that will happen. If you see the annual increment cycle, it kicks in from 1st of April, so we have taken the full impact in the quarter. Going forward, we don't see an additional impact because of any salary increases or any such one-time impact that we get. So the impact is there fully in this quarter. There is no part of the month impact that you're seeing. Does it answer your question, or was there something else you wanted?
No, that surely answers. And broadly, on the fixed investments, like our depreciation is also higher. So from fixed investment perspective, can you give us some color? Are there any specific investment needed in the rest of the year?
Sure. So you're right. See, from an investments perspective, there is a lot of requirement from a RTA perspective, from a SEBI regulatory perspective also, that there is an investment that we need on assets, on storage, on servers, on compute, etc. So if you see, the last year was probably a record year in which the amount of investments that we made on capex was in excess of 60 crores. Right. This was to bring us in line with the SEBI requirements of a 2x capacity, as well as have a provision for the future. The SEBI norms are that at any point of time you should have a 2x capacity of your peak transaction processing that happened in the last quarter. Which is, for example, if you have say 10 today and 20 tomorrow, and then come back to 15. But by the next quarter, we will have to get 20 to 40 capacity provisioned in the entire system, which is not only from storage perspective, it's also from a compute perspective, from a transmission perspective, everything that we will need to invest in capex. So we have taken a big decision to actually upgrade our entire infra in the last year, so that we are not only in conformity with SEBI norms, we also have a provision for the future growth that we see, because this is not something that we can do in a fits and starts. So we did a big investment of around 65 crores, between 60 and 65 crores last year. We don't see that repeating year on year, if that's your question. Although we will continue to make investments as needed to maintain and enhance this capacity to take care of market transactions. But we don't expect the volume of investments in capex that we made last year will get repeated every year. If you see, in fact, on a quarter-on-quarter basis, Anand, the depreciation charge would have actually come down when you compare the last quarter to this quarter. So we don't see this level of investments on a year-on-year basis, although there will be significant investments that we will continue to make.
Sure. So the depreciation charge falling quarter-on-quarter is about 1.89 crores. What explains that?
So this is basically, the bulk of investments that we did during the COVID phase as well as post this. It's a pure function of different on value method, right? See, the bulk of the depreciation gets done, around 65% of depreciation gets done in year one of the norm is that you have to get a 95% depreciation within 3 years. So if you see, the bulk of the depreciation gets done in year one and part of it in year two. So as you come to year 3 of the year 2 and year 3 of this, if you don't make matching investments in terms of quantum, the depreciation will come down, and that's what has happened in this quarter.
Got it. And my last question is on monetization. In the opening remarks, we spoke about monetization of MF Central and other initiatives also. If you can give us some color, are you expecting any of the initiatives to start contributing in next coming quarters?
Yeah, sure. So if you see, MF Central as a standalone entity is generating a lot of interest, and we are at a sign-up stage now, but we believe some level of revenue will perhaps start showing up by the end of this quarter or beginning of next as integrations happen. Similarly, you saw that on CAMS Wealth, which is our digital onboarding platform, we've seen very strong response in terms of sign-ups. The other two big things then, therefore, are account aggregator, which has been a build-out over the last 5 or 6 quarters, and CRA NPS, which has also got built out over the last 5 quarters. So we are in a sign-up stage there. Small trickles of revenue are already coming in. It will perhaps take up to the end of this year for any, I would say, substantive revenue reporting to happen. But like ENPS, we get paid for every registration and every transaction that happens. So that business is obviously on. So is the account aggregator and TSP business. I think significant revenues worthwhile reporting in a forum like this will perhaps happen in 4Q of this year.
Noted. Thank you. I'll come back in the queue.
Thank you, sir. We take the next question from the line of Prayesh Jain from Motilal Oswal. Please go ahead, sir.
Yeah, hi everyone. Few questions from my side. Firstly, could you give us the breakup of the employee cost or the increment, whatever you've given from 85 crores to 93 crores, as to how much was accounted by increments, how much by variable pay, and how much by the investment in other companies or other subsidiaries?
Sorry, I could hear part of your question, Prayesh. If your question was what is the breakdown of the 20 crores employee cost increase that you have given year on year, I'll answer that question. See, as I said, almost 7 crores of it, 6.5 crores of it is a non-cash increase that's happened because of the ESOP plan that we have given to the top 120 executives in the company on the 1st of April. Accounting standards requires us to take a charge, a non-cash charge, depending on the vesting schedule. So if you take that away, that's looking at a 14 crore increase year on year. Most of it is because of the increments and the hiring that we have done from a tech perspective. Almost like 35% of the increase is because of that. Which is not only the fresh hiring we are doing from a tech, which we have not slowed down for obvious reasons. We just want to maintain our edge on the tech perspective, but also the higher increment that we will have to give than usual, given the red hot market that is there for the tech resources. So that's major part of it. Apart from that, there is this FT that has come in the current year. If you remember, we did this migration of FT in July, August of last year. So we actually got in some costs because of that. We didn't have a corresponding cost in the last year. So that's some 2 crores is increased because of that. And the remaining cost is the increment that we have given to the existing resources. Given the market condition, not only tech, other resources are also to be retained. Last thing we want is a runaway attrition that's happening. So the increment cost, the ESOP cost, the FT cost, as well as the tech hiring cost will kind of constitute every paise of this 20 crores increase that we have given.
Okay. So what would be the ESOP cost here that you would look at?
On the first quarter, we took a charge of around 9.5 crores in the P&L because of ESOP. And that was around 6.5 crores more than what it was in the comparable quarter last year, and around 2 crores more than the sequential quarter.
So for the full year, should we look at a 40 crore kind of a hit?
For the year, the current year, we expect it to be around 28 to 29 crores. Because there is a vesting schedule-based amortization. As you go along, the cost decreases in the subsequent quarters. So for the year, we expect the ESOP amortization to be around 29 crores.
And from a margin guidance perspective, you guys have been maintaining that in that quarter you will have a 38% kind of a margin and 38-40% kind of a margin, and good quarters will have 40-42% kind of margin. Do you think this was the worst quarter for some time now, and things will only improve from here on with regards to overall margin outlook?
So let me try to answer that. Yes, you know that we've broadly given a guidance of 40% and early 40. If you see the last quarter, like we said, the revenue build out was slow, and then for various reasons we continued the investments in all the resourcing that we had to do for the newer platforms. A lot depends upon asset growth and revenue build out. As you know, as we've said, that we will continue making the investments. There is absolutely no reason to go slow on the investments. Wherever we invest, you know that when the platform play becomes successful, then the offtake is large and that leads to revenue growth. I think both the MF business and the AIF business are great examples of all the past investments which are playing out now. So therefore, it's a good question to ask, is this the worst quarter? The way I would answer it is that depending upon it turning positive and the revenue play at least holding, yes, certainly we believe that this could have been the worst quarter, but we will continue watching in terms of how the markets behave. As you've seen, while flows were very positive and flows are what held everything together, mark-to-market losses did happen even in the equity segment. If that is bottomed out, certainly margins will start looking up in future, but that's something we're watching closely.
Okay. The other part of that equation is the yield front, wherein the mutual fund companies, AMCs, we've seen that there is pressure on yields which is mounting every quarter for them. Even this quarter, among all the listed players except for one of the companies saw a decline in yield. Is there an incremental pressure coming to you guys for reducing your fees?
So you know how this works is, as you're aware, our scope continues to grow significantly year on year as more regulatory and service scope comes in. So the absolute quantum of work that we do becomes bigger and bigger. The only way we get paid for it is through, sales and mark-to-market gain. Also, mutual fund companies do get a fee remission every time they grow. Like you're aware, it's a telescopic fee structure. So within that, I will not say that there are no dialogues. Obviously, mutual fund companies will try to find ways to offset whatever they're seeing on the fee front themselves. As far as we are concerned, we are confident that given the value that we deliver in the marketplace, the expanding scope and obviously the sophistication that we are bringing into the company, we will hold on as much as possible to the yields.
My last question is on the non-mutual fund business. What explains the decline in this quarter sequentially?
Sorry, you are.
I'm saying on the non-MF business has seen a decline in share as well as in absolute quantum if we back calculate it from the overall revenues. So what explains the sequential decline in the non-MF revenue?
Yeah, so that's right. So as I mentioned in my initial commentary, AIF is a bright star in that we continue to grow quarter on quarter. But other businesses have not grown sequentially. There are various reasons. One is for example, from insurance repository perspective, we generally see the fourth quarter is when there is a new policy conversion is at the maximum, and hence there will be a sequential drop in revenue from the Q1. Because of NFO being on freeze, and additional plans, there is some muted growth on that. So our new KRAs and hence our KRA business is not kind of firing in the first quarter. We hope some of it will be recouped once the NFOs come back. And in terms of payment businesses, there is a general drop in volume, although SIPs remain stable. But on a quarter-on-quarter basis, you would see that it's not been a big growth at all. So we see some amount of drop in ACH new registrations, especially in the payments business. So combination of these factors actually led to the drop of non-MF revenue on a sequential basis. That's the answer, Paresh.
Yeah. Thank you. Just a feedback, if you can start breaking down the revenues of non-asset mutual funds, non-asset based as well, wherein how much is the quantum of AIF, how much is the contribution of CAMS pay, and how much is the contribution from the insurance business. And if you could split it up, that would be also helpful for us in terms of tracking because these are the next avenues for growth. So if you can, if you're able to get that breakup, that would be helpful. Thanks. That's all from my side. All the best.
We'll do that. Just to give you a perspective, AIF is around 3% of overall revenue. And CAMS pay will be around 2.53%, and insurance would be around 2 to 2.5%. So, but yeah, we take your point and we will do that. Yeah.
Sure. Thanks. All the best.
Thank you, Mr. Jain. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone phone. Participants, you may press star and 1 to ask a question. We take the next question from the line of Madhukar Ladha from Elara Capital. Please go ahead, sir.
Hi, good morning. So a couple of questions. One on this acquisition of Fintuple Technologies Private Limited. I don't know what the exact function of this company is. So maybe you can tell us what you have acquired over here and for how much, and what is the contribution in revenues and profit for this current quarter and for the year. Maybe some sense on financials or last year's financials of the company. That'd be helpful. Second, you mentioned that last year you did about 60 to 65 crores of capex. Now, what would be your capex budget for this year, and how do you see your capex evolving over the next 3-4 years? What would be the amount for that? That'd be helpful to know. Yeah, those would be my 2 questions. Thanks.
Okay, sure. So let me try to answer the second question first. Just in terms of capex, I think the way it was explained, in the last 2 years, we've seen a significant build-out, spurred by 2 or 3 reasons. One, of course, was equipping thousands of people to work from home. As you know, that's capital intensive. And the second is that every year the expectations from our industry, from a tech architecture and capacity perspective, is to move closer and closer to the MIIs or the infrastructure institutions. That continues to place newer demands in terms of how much redundancy, how much storage, how much compute capacity we keep in-house, and the element of redundancy that we have. So like last year, Ansarin said, gross company level capex was about 65 crores. In a typical year, this number would be more in the 35 to 40 range. We did that just to, although we were obviously compliant to everything that was required, to significantly gain on sophistication to make sure that we were able to eliminate things like downtimes, etc., in case we were switching things over from one data center to another. All of that happened. That depreciation is showing up. Like he said, because it's on written down value, you will see, and we are seeing some quarter-to-quarter depletion in depreciation itself, but last quarter and this quarter were high. From a contrast perspective, if last year was 65 crores, this year would be in the range of 35 to 40 crores, because a large investment has already been made, and of course, some of the replacements, new licenses, security tools, etc., continue to get onboarded. So the answer is it will be about 35 to 40 crores this year. On Fintuple, sorry, did you have a follow-on?
No, got it. Thanks.
Okay. On Fintuple is a company which works in the fund administration space, very similar to what CAMS does. They were a competitor, especially in the digital onboarding space, for AIF and PMS. Over a period of time, they've broadened their capability to offer broader fund administration solutions, especially to banks, their custody businesses, their PMS businesses. So that's what they do. It's a small company. Revenue numbers, etc., are pretty small right now. They are growing quite well and are acquiring newer clients, like I said, in the fund administration space. Also in the e-sign and eKYC space, now they're expanding their footprints. They were suppliers to one large bank, but we are expecting this will expand to at least 2 or 3 banks within the year. So that's what Fintuple does. They're based in Chennai.
And any color on the revenue profit numbers last year, and how much did you pay for this acquisition?
So, Madhukar, this is kind of a startup. What we have bought them for was more kind of technology and the exciting product and inroads that they're making in the onboarding world. So this is the revenue is starting to build out now. So it will not be significant in the last quarter. Of course, we expect that they will grow in the current year. Just to give you a perspective, their revenue would be sub 1 crore in a quarter. But going forward, obviously, we expect that to multiply in the next few quarters or next few years. So there's more kind of a acquisition for the niche product that they have, complementary to what we have currently in the AIF market, and obviously the exciting AIF market that we see. So that's from a payment perspective. I will not disclose that so far, but I'll just give you a broad guidance. See, if you take the credit even for the money in their balance sheet currently, out of which we're entitled to the majority stake, the acquisition will be not significant, will be less than 10 crores acquisition cost.
Understood. Thank you.
Thank you, sir. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone phone. We take the next question from the line of Kaushik Agarwal from Haitong. Please go ahead, sir.
Yeah. Hi, sir. Thank you for the opportunity. I have few questions. So, sir, firstly, on this AIF business, what I wanted to understand broadly in terms of the revenue model, as you have earlier mentioned that this is broadly the yields that you charge on the AUM, but onboarding new clients also helps us in getting some upfront revenue. Like when we onboard a customer, do we book some revenue at that time also? Number one. Number two is broadly I want to understand the competitive intensity in this non-MF business. Is it similar to what we are seeing in the MF business as well? Like broadly in terms of the AIF, account aggregator and the insurance businesses. And lastly, within the account aggregator business, we have started, have we started monetizing the client addition now? And can you please highlight some broad idea in terms of what is the contribution of this business to the top line and how should we look this business way forward?
Sure. So overall in AIF, it's typically like, either a bits price business or a fixed fee for scope kind of a fee structure. Especially in digital onboarding, we do get paid for every customer which is coming in. So onboarding pays for itself, largely on the digital side. Otherwise, if it's an asset-based pricing, then typically we get paid once the assets come under management of the AIF. What is the competitive intensity? Like you have seen, we have pointed out that at an aggregate, our share when compared to the rest of the market is in the range of 50%. It's not a very competitive, very fragmented market right now. Of course, newer players are wanting to come in, but right now it's a small market with similar names as you know in the mutual fund market kind of competing with us. On the account aggregator side, however, and I'm still talking of competitive intensity, the market is very different. If you see TSPs, which is technology service providers registered with Samati, and the people who are competing in bids, you will see 10 to 20 names in perhaps every bid, and you will see over 20 registrants. If you see license holders in account aggregate, there are 5 license holders, 4 live, 1 about to go live, but about 4 to 5 with in-principle approvals. All those names are out there on the website. When do we start monetizing? Monetization happens once you are connected to an FIP and an FIU, and they are paying you money for all the consents which are coming in. So that has begun happening right now. The volumes are small, so it is not a significant number to report. Like I said, we are expecting this build-out to continue, and maybe by the end of the year, maybe by the last quarter, those numbers will become significant, at which time we should be able to give you a color of how much money they are able to contribute.
Understood, sir. Sir, just a follow-up on this account aggregator business. What we are seeing is lot of players are now coming up and applying to the RBI for this account aggregator license, and many of them have also received this in-principle approval. And most of these players, with what we are seeing and what we are picking up from the media is these are already into this fintech space. So, do you see like these players coming in would impact our business or would increase the competitive pressure?
Yes, certainly. So there are usually 2 kinds of players. One set of players, and you refer to fintechs, are those who would like to do this mostly as a captive business. Some of the names who've got in-principle registration are wanting to do that, which means that they want to use this utility for portfolio, personal finance management, for lending, etc., but don't want to outsource the work, and they've applied for a license so that they do it captively. However, that number and percentage will be small. Not more than 10% of the entrants will do it in a captive way. The balance 90% will be part of the competitive landscape. They all come with different specializations. But yeah, it will increase the competitive intensity. So it will be very different to the markets we have been in so far, which have been more niche markets. This will be a broader market, and most of the people who are applying will be out to sell in the marketplace.
Understood, sir. That was very helpful, and thank you so much. That's it from my side.
Thank you, sir. We take the next question from the line of Mr. Anand from White Oak. Please go ahead, sir.
Thank you again for the opportunity. With regards to this inorganic, method of acquiring capabilities, do you see this being a recurring thing for us, or should we see this as one-off?
No, we certainly see it as a recurring theme for us. The left-hand side of the equation, as you know, is very attractive, which is that we have the ability to generate and mobilize the cash and be able to do the deals, and we have a strong management team which can help onboard businesses. The right-hand side has to be an asset which makes sense. So like I said, Quintuple was something which made sense. It is a very small acquisition, you can say, so it is not done purely from a revenue or market share perspective, but a good capability and a good set of people came on board. So it is certainly on our radar. Like we have said in the past, we want to be very focused and stay in the relevant area, so we will not do anything unrelated. But very much on the cards, and like I said, the left-hand side of the equation is attractive. We're just figuring out the right-hand side in terms of are there attractive assets which have built out a business in terms of revenue and market share, which could appeal to us.
Noted. And the team that comes with Fintuple, they would have certain lock-in, right, for the amount of time that they at least spend several years at it.
Yeah, the way we've done it is we've made an acquisition of 51%, and the rest is available for the promoters to monetize their holdings in the third, fourth, and fifth year. And the reason we've done it is we didn't want the management team to walk out once they've got money in the bank. So money in the bank will take up to the fifth year for them to happen. So that is kind of a lock-in.
Got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Ramcharan, CFO CAMS, for the closing comments. Please go ahead, sir.
Thanks, Seema. So we thank you for your interest and participation in this call, and hope you continue to follow our progress and our journey. Please do reach out to Orient Capital or Anish Savlani for any questions that you may have or follow-up that you may have. And thank you for your time here. Thanks.
Thanks everyone.
Thank you.
Thank you, everyone. On behalf of Computer Age Management Sciences Limited and Orient Capital, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.